A very good morning, friends. So I hope you're all doing well. And most importantly, I guess you've seen the previous class and revised it as well. So in the last class, we started off with the concept of business combination. And I've basically given you a couple of things in the last class. One is we learned that which permutation combinations with standards would apply. And I guess if you're typically looking at Ind AS 103, then there are three focus points which I gave you in a three-step model. One is that you need to acquire a group of assets. Number two, that group of assets need to be a business. And number three, we need to get a control over that particular business, and then only Ind AS 103 gets triggered. We also saw in a little detail that how does an entity identify that they have acquired a business. And for this particular purpose, there are two tests which are there in the Ind AS. One is the optional concentration test, which is a choice of the company, they want to apply it or not. And if they choose not to apply, then they need to apply the three-element test of input, process, and output. And in case they apply that particular test and they pass the test, we reached a conclusion that it is not a business. But if they apply the test and they fail the test, then again, you need to apply the three-element test. So we went through the optional concentration test where I gave you the three steps. And I also gave you the three-element test where also I gave you a three steps to apply. So I think now we are very clear in terms of what is a business combination and what are the parameters of identifying that a particular group of asset is a business or not. And in the last stage, I had also given you some inputs regarding that, there are three kinds of questions which you can confront under Ind AS 103 in the examination. One is a case of acquisition accounting. The other is a case of reverse acquisition, though I didn't tell you exactly what is a reverse acquisition. I just gave you a term that it could be an acquisition accounting, or it could be a reverse acquisition, or there may be something what is called a common control transaction. But of course, I made a mention that, depending upon the transaction is with a related party or it is an unrelated party, accordingly, one of the situations could follow. Generally, when you see a case of a common control transaction happening, which is a case of Appendix C of the standard, you would see that it is a related party transaction. And if it is an unrelated party transaction, it could either be a case of acquisition accounting, where the main text of the standard addresses the acquisition accounting. And if it is a case of a reverse acquisition, then the Appendix B of the standard addresses the issue. Right now, my focus is not on the reverse acquisition or on the common control transactions. I'm going to focus on the acquisition accounting with you. So I also said that as a part of the acquisition accounting, we've got a 7-step model. Now, let me clarify. This 7-step model is not something which is, explicitly given in the standard. I just made it for the ease of convenience that once you do a question on acquisition accounting, in a very chronological order, what we need to do in a question. Because generally I've seen, that if you get a larger question in the exams, which is almost like a 16 or a 15 or a 20 marker exam, we generally confront a problem in terms of what is the methodology, how we're going to crack that particular question. So to make it easy, we're going to concentrate on a 7-step model so that we can easily crack the question. Now, before I start with the 7-step model, I need to give you some basic understanding so that at least you get a flow of why we've created this 7-step model and what exactly are we going to do in this 7-step model. So I think let's start the journey with you. So that was a quick recap of things with you. So let me start the journey with you, friends. Once again, a very good morning to all of you. So let's begin, friends, now. Now, when I'm looking at the concept of acquisition accounting, there is a particular journal entry which comes to the mind. So as a part of the acquisition accounting, there is a particular journal entry which comes to the mind. And what is the journal entry? we are going to pass an entry in the books of acquirer. We are going to pass an entry in the books of the acquirer, and this entry will be done on the date of acquisition. Please mind the words very carefully. I'm going to pass an entry in the books of acquirer, and this entry will be done on the date of acquisition. And this entry which I'm going to pass in the books of the acquirer looks something like similar to what you used to do in terms of IGAAP in Accounting Standard 14. Slightly different, but more or less the essence is quite the same. So in this particular case, when I do the entry is going to be assets which have been acquired will be recorded as a debit, and we will be recording the liabilities and they will be given a credit in the entry. Indirectly, you've recorded the net assets, you can say. Then there will be a purchase consideration which is paid, and the purchase consideration will be given a credit. Last class also I made a mention, and I think I'm again going to make a mention, that when you're going to record these assets and liabilities, these assets and liability is going to be 100%. So if a company acquires a control over the business of another company, in the part of the acquisition entry, you got to record 100% assets and 100% liability, even though you might acquire, let's say, a 60% voting power in a company. But the consideration which you paid, let's say if you acquired 60% shares, then the purchase consideration recorded is to the extent of 60%, which creates a mismatch because you've got 100% net assets on one hand and the purchase consideration reflects only 60%. So what we're going to do at this particular stage, we will be putting the NCI, that is the non-controlling interest, also on the credit side. The remaining 40% of the voting power is held by those who are having no control. So therefore, they are called non-controlling interest. In IGAAP, we used to use the term called minority interest. But in Ind AS, we don't use the word minority interest. We use the word called non-controlling interest, that is NCI. But technically, MI, there is minority interest, and NCI practically, of course, means one and the same thing. Now, once you put this entry, that is net assets, the purchase consideration, and NCI, you are going to get a balancing figure in this particular entry. And if the credit side exceeds the debit side, you get a balancing figure which is supposed to be a goodwill, or you used to get a capital reserve as a balancing figure on the credit side. Because once you compare the debits and the credits, you are going to get a balancing figure which is going to be a goodwill or a capital reserve, right? So in Ind AS 103 in acquisition accounting, trust me, we are going to work upon this entry. And since we need to pass this entry, we are going to arrange things on a step-by-step model. Now watch the steps very carefully in this case. So what I'm going to do, I am going to first of all go to the step number 1. So when I say the books of the acquirer, so in step number 1, what I'm going to do, I will first of all identify. In step number 1, we will identify, mind the words, accounting acquirer. So in the step number 1, what I'm going to do, I'm going to identify the accounting acquirer. I did not say that I want to identify the legal acquirer. I said I want to identify the accounting acquirer. Now you would say, sir, how does that make a difference? Is the accounting acquirer and the legal acquirer supposed to be two different entities? Possibly, yes. You know, if a company takes over the business of another company, and in the scheme, the High Court also approves the fact that, let's say, A is the legal acquirer, it is not necessary under Ind AS that A, who is a legal acquirer, is also classified as an accounting acquirer as well. This entry, as per Ind AS, needs to be passed in the books of the accounting acquirer, who is identified as an acquirer from the accounting point of view. It may not be the same entity which is designated as a legal acquirer. No worry, we're going to see those entities into cases when I come to step number 1. So since I need to pass the entry in the books of the accounting acquirer, so the very first focus would be a step number 1, getting who is the accounting acquirer. Then we go to the step number 2. And in terms of step number 2, we need to get the date of acquisition, the DOA, as I call it, the date of acquisition. Because this entry which you're passing in the books of acquirer has to be recorded at a date of acquisition. So you need to identify what is the date of acquisition. Okay, then as a part of the step number 3, what I'm going to do, I will organize the information of all the assets acquired and all the liabilities assumed. Mind the words, I'm using the words very carefully. I'll make a list of all the assets acquired and all the liabilities assumed in a business combination. So this is going to be a data which I'll arrange in step number 3. I will create a list of net assets. I'm putting it as NA. You'll understand that we need to get the list of net assets. So all the assets acquired and the liabilities assumed, we're going to make a list in the step number 3 so that we get the data. Then as a part of the step number 4, I'm going to calculate the purchase consideration. So step number 4 is going to be a calculation of a purchase consideration. What is the consideration? The acquirer company paid to the shareholders of the acquiring company in order to acquire the business. So I'll arrange the purchase consideration in step number 4. Now, there could be some kind of complications which could arise under each step. So therefore, we will go to work on a step-by-step basis. We'll understand the complexities under each step, and then we'll look at a larger question as well. Then as a part of the step number 5, I'm going to organize my NCI. So step number 5 would be the computation of the non-controlling interest. So there is a particular procedure. There is a particular way in terms of calculating the non-controlling interest as well. And then as you can see, either it's a goodwill or it's a capital reserve. So this is going to be my step number 6. In step number 6, or what is the amount of capital reserve. In Ind AS 103, this capital reserve is technically called as a bargain purchase gain. You'll see the word, it is called a bargain purchase gain, but technically, yes, it is a capital reserve, but we need to be seeing later that why do we call it as a bargain purchase gain? There is a little difference in terms of what IFRS suggests and what Ind AS suggests in terms of treatment of this capital reserve. But this capital reserve can also be called a bargain purchase gain. Wow. So I think my 6 steps is done. So where is the 7th step? Well, the entry which you're passing, the acquisition accounting entry, this is the finally step number 7, where I'm going to put the journal entry in terms of the acquisition accounting. So which means at the end of the day, I am simply working towards the journal entry. My focus is step number 7. So get this very clear that I am focusing on the entry which I need to pass in the books of the accounting acquirer on the date of acquisition, for which I need certain information, which I'm organizing in a 7-step model. The focus is the step number 7, that you need to put this entry, and we're going to identify every element of this entry through a 7-step model. Identify the accounting acquirer, get the acquisition date, make a list of the net assets, get the purchase consideration, and then calculate the NCI, get the goodwill or capital reserve, that is a bargain purchase gain, and put everything in the form of a journal entry. I think you would have got a clarity in terms of my 7-step model, right? Let me see if any questions coming to your mind so far. Okay, that's great. So I think nothing so far, so good. So now what I'm going to do, I'm now going to work on every step with you. So whatever complexities can come, because in the examination, you could get a questions maybe on a particular step itself. Like, for example, you could get a question maybe on step number 4, which is on a calculation of a purchase consideration, because calculating PC unlike accounting standard 14, can be a complicated affair in terms of Ind AS 103. So you could get a larger question which is comprising of all the 7 steps, or you could get a question which is just based on a particular step only. Okay, let's begin the journey. Having understood this now, I am now going to take you forward, and I am now going to go on step by step. So what I've done, I've organized an assignment as well, and of course that would be shared to you. And in that particular assignment, you'll see questions on every step. So the questions have been organized on a step-by-step basis. So there will be few questions. I will do a few questions you'll get for a practice so that you can get a good hold on the concept. Okay. Let me start the journey in terms of step number 1, where I'm saying that I need to identify the accounting acquirer. Let's get the focus clear. The focus is on the accounting acquirer. Now, I'll just give you a very simple chart, and trust me, with that, you'll be able to get the accounting acquirer easily. There are 2 important focus points. Hear me very carefully, friends. We'll do the application of the concept as well, but let's first get one thing very clear. There are 2 very important aspects in terms of identifying the accounting acquirer. Number 1, the form of the purchase consideration is in which form? That means the purchase consideration is discharged in terms of cash, or the purchase consideration is discharged in terms of equity shares. That's a very important element, that the purchase consideration is in which form of payment. Are we giving a consideration in the form of cash to the shareholders of the equity, or are we giving equity shares to the shareholders of the equity? So I think before I make a chart, let's give you a very simple example to understand something important. Let's look at an example first. Now, let's consider that there is a company A, and let's consider there is a company B. And let's assume that the number of shares in the company, let's assume that the number of shares of company A is, let's say, to the extent of 100 shares. And let's say company B has got a total of 60 shares in the company. Now, A approaches B and he wants to acquire a control of the business of B. So he tells the shareholders of B that I will give you 1 share for every 1 share in the company. So A goes to the shareholders of B and tells them that I want to acquire a control over this company. So you give me your shares and I will give you instead 1 share in my company for every 1 share in your company. Now, let's get to the calculation. In this particular case, if I look at post-acquisition, if I look at the status post-acquisition, can I say the shareholders of company A has got a total of 100 shares? The shareholders of company A have got 100 shares in the company, but what is the total share capital of the company post-acquisition? 100 shares were already there in the company, and A gave to the shareholders of B another 60 shares. That means the total number of shares in company A has become 160 after 60 shares are given to the shareholders of B. So let us see what is the status of the percentage the shareholders of A enjoy in the company. So they've got 100 by 160. So they've got 62.5% stake in the company. Now, please hear the language carefully. Hear the language very carefully at this stage. When A acquired a control over the company B, naturally the percentage stake of the shareholders would dilute. The shareholders of company A who had 100% control of the company, their percentage definitely dilutes, and this is bound to happen. If you're going to give shares in your company to somebody else, naturally your number of shares remains 100 and the capital base increases. So the percentage is definitely diluting, but still you've got more than 50% stake. And as I said, for the ease of convenience, we're going to consider that you get a control over the company when you've got more than 50% voting power in a company. Since the shareholders of company A has got 62.5% stake, they still control A. The shareholders of company A still control A, which means in this case, A is supposed to be, you can say, both a legal acquirer as well as an accounting acquirer. He issued the shares. He is a legal acquirer because legally he is acquiring B. He is a legal acquirer, and post acquisition, you can see that the percentage falls down from 100% stake to 62.5% stake, but he's still under the control of the company A. The shareholders of A still control the company A. Let's look at a contrasting example. Let's consider an example with the same figures, but slightly let's change the ratio of exchange. Let's consider the number of shares to be same, that is 160. Now let's assume the company A told the shareholders of B that we will give you 2.5 shares for every 1 share. I know you cannot give a fraction shares to the shareholders. You cannot say that I'll give you 2.5 shares for every 1 share. I know that is something which is, vague. But don't worry, let's not get into the fraction part. I just want to show you something. So let's say company A shareholder says, I will give you 2.5 shares for every 1 share held. So this means now if I look at the post-acquisition percentage, what the company A shareholders have, they had 100 shares in the company, and they've also issued how many shares to the shareholders of B? 60 into 2.5. So they gave 150 shares to the shareholders of B. So the total capital base of the company A is become a total of 250 shares. The company A had 100 shares with them. They gave 150 shares to the shareholders of B. So the total number of shares in the company is 250. The company A shareholders have got 100 shares out of the 250 shares. So what is the percentage stake? If you take 100 divided by 250, it works out at 40%. Oh my God. If they've got a 40% stake in the company, now imagine A issued the shares. But after the issuance of share, he loses the control of the company. Indirectly, the 60% stake is with the shareholders of B. So who is in effect getting a control over the company? The control has gone to the shareholders of B, though the person issuing the shares is A. But the control effectively passes on to B, and that's but natural that you landed up paying so many shares to the shareholders of B that ultimately the control moves from A to the shareholders of B. Now, if this happens, he is lost control. And if he has lost a control, in this particular case, we say this is not acquisition, this is called a reverse acquisition. If you technically see, this is exactly a situation where we can say that this is a case of a reverse acquisition, because the company which is acquiring the shares, and issuing the shares ultimately doesn't control the company. The control is passed on to the acquiring company B. So in this particular case, we would say B is supposed to be the accounting acquirer. Company B is supposed to be the accounting acquirer because the shareholders of B is technically getting a control over the entity A. In this case, A is supposed to be the legal acquirer. He is undoubtedly a legal acquirer, but he would be treated as an accounting acquiree. Mind the words, he would be treated as an accounting acquiree from the Ind AS 103 point of view. So which means that if the consideration is paid in shares, mind it carefully. If the consideration is paid in shares, I need to do some calculations. If the consideration is paid in shares, we need to do exactly the same kind of calculations which I've done. You need to see the status of the percentages post-acquisition. The company which issued the shares, even though the percentage dilutes, but is it still in control of the company? If yes, it's a case of acquisition accounting. If the company which is issuing the shares loses the control over the company, then it is a case of reverse acquisition. Though legally, I would say A is the legal acquirer, B is the legal acquiree, but from the accounting perspective, A becomes an accounting acquiree and B becomes an accounting acquirer, and that is a case of reverse acquisition. I hope my concept, my calculations are pretty clear to you. So this was one input which I gave you, which would also give you a feeler that when is it a case of acquisition accounting and when is it a case of reverse acquisition. You mean to say that every time the consideration is supposed to be in terms of equity shares, we should land up making some calculations on a post-business combination levels? Yes. And you are going to see that the control is still continued or the control is lost. If it is lost, it is a case of reverse acquisition. Now, let me come back to the chain of thought and let's give you an interesting chart where it'll help you to identify the accounting acquirer. No worry, we're going to do some questions also with you on that area. Let me see if there are any still questions coming in. Otherwise, we'll take the journey forward. Okay, I think, yes, great. Okay, so let's, I think, take the journey forward. Now, I'm going to create a simple little chart, friends, to you, so that all the permutation combinations gets contained in the chart. And we are able to appreciate that in which situation, who is the accounting acquirer. Let's make an interesting chart. This is the crux of the standard which I am giving you. So I think let's do this. I'm going to first create a permutation combination. So let's consider a chart where I'm going to give you some permutation combinations in this case. And I'm making basically a total of 4 columns in this case. Okay, so I think let's begin the journey. I am giving you the inputs on the step number 1. In terms of step number 1, we are looking at identification of the accounting acquirer. We're looking at the identification of the accounting acquirer. Now, there are 2 important things which you need to watch out. Number 1, you need to see that for the purpose of acquisition, no new entity was created. So you need to see at the first instance that for the purpose of acquisition accounting, no new entity was created. Now, you would say, so what do you mean that no new entity was created? Don't worry, I will give you examples and we'll see that how the accounting takes place. But to give you an example, let's say if I'm looking at that there is a company A, there is a company B, these are both existing companies. So if you're looking at a deal between existing companies, no third entity was created for acquisition, then I would say it is this case, no new entity was created. This means the deal is happening. The deal is happening between the existing companies. So if the deal happens between the existing company, that's one case. Second, if I look at the input, we can say new entity is being created. New entity is being created. So you'll have to first of all read the question carefully and identify, is a new entity being created or not? Now, when I say a new entity is created, let's take an example. There is a company A and B. These are existing companies and company AB takes over the company A and B. So basically, you can say it merges the 2 companies A and B and creates a new company AB. So if a new entity is being created, that's a different case. So your first focus point in the question is got to be on the basis, have we created a new entity or not? If you say no, it's case 1. If you say yes, it's case 2. Focus number 1. Second, after this particular point of time, what you're going to do, you are now going to see that the purchase primarily in cash. I use the word primarily. Because if you look at Ind AS 103, and it very clearly says that if the consideration is primarily in cash, I'm not saying that it is 100% cash. But from the examination point of view, you might see questions where the considerations might be totally in cash, or the considerations might be totally in equity shares, or maybe blended. But the standard says the word that the consideration is primarily in cash, or the consideration is primarily in equity shares. So the word is that the consideration is primarily in cash or primarily in equity shares. The same combination works out here. The consideration is primarily in cash or it is primarily in equity shares. So the chain is very clear. I'm not taking you to the language of the standard where all these permutation combinations are given, but if we read the standard with the appendix, you get a crux, and I'm just giving you a crux chart on this. And the logics I've given you already for this one. I've given you some logics already. So there are, you can say, a total of 4 permutation combinations which could arise in terms of identifying the accounting acquirer. Your focus one is a new entity was not created, a new entity was created. And then the second focus is the consideration is in which form. Is it primarily in cash or primarily in terms of equity share? Now, one thing simple. If the consideration is primarily in terms of cash, irrespective a new entity is created or a new entity is not created, we can say generally, I'm using a safe word, generally the company which pays cash, the company which pays cash is supposed to be the accounting acquirer. Generally, I'm just using the word on a very safe side, that generally the company which pays cash, the company which pays cash is supposed to be the accounting acquirer, because in this case, the question of control getting diluted doesn't arise. If as a company, I acquire a control over the company and I pay a consideration to the shareholders in cash, well, I can't lose a control over my own company. So one thing is very simple, that if your consideration is primarily paid in cash, it can never be a case of reverse acquisition. I'm saying from the examination point of view that it cannot be a case of reverse acquisition. So I can say in this case, as well as in this case, it is very clear that it would not be a case of, reverse acquisition. You would see it will always happen to be a case of acquisition accounting and not a case of reverse acquisition. Simple and straight. Now, let's come to the combination where the consideration is paid in terms of equity shares. And I think you've already seen that if the consideration is paid in terms of equity share, we need to calculate the post-business combination percentage. You need to calculate a post-business combination percentage, which I showed you in the previous example. You need to see that after the shares have been issued to the shareholders of the acquiring company, do we still retain a control or did we lose a control? So there will be 2 permutation combinations which could arise. When you calculate a percentage post-business combination, the control is there. The control continues. Even after the issuance of the shares, the control is diluted, but it still continues. Then it is a case of acquisition accounting. It's not a case of reverse acquisition. It's a case of acquisition accounting. But if you say that the control gets lost because you've given so many shares to the shareholders of the acquiring company that your control gets lost, then in that particular case, it is definitely a case of reverse acquisition. And you know that in this particular case, who is the accounting acquirer? So when it is an acquisition accounting, we can say it is acquisition accounting applies. That means who is the acquirer? Who issues shares? Who issues the shares becomes the accounting acquirer. But if it is a reverse acquisition, we can say it is the legal acquiree. It is the legal acquiree who becomes an accounting acquirer. And I've already supported this part with a simple little example as well. Now let's come to the 4th combination in this case. If you say that the new company is being created, I think I can say one thing, 100% it would be a reverse acquisition. And the logic is simple. Imagine a company AB is created and it issues the shares to A and B. Can I say ultimately the entire shares of AB is held by what? Shareholders of A and shareholders of B. So in this particular case, if the company AB is created and the shares are allotted to the shareholders of A and B, all the shares are there with A and B shareholders, then somebody, one of them has to be the acquirer. Because whosoever gets more than 50% stake in AB is supposed to be legal acquirer. So I would say the moment you create a new company, it is very clear that generally, I'm still using a safe word, that generally it is always a case of reverse acquisition. So it is always a case of reverse acquisition because the new company which issues the shares cannot get a control over the company. It is the shareholders of A or B who gets a control. So it'll always be a case of reverse acquisition. So we can say either we'll have to evaluate either of the existing company. So it's either A or B. So either of the existing companies will be the accounting acquirer. So we can say one of the existing companies would become an accounting acquirer in this case for sure. So this is all the permutation combinations which can arise, the complications which could arise in terms of identifying the accounting acquirer. Let's get this straight and then we can do some questions with you. So just let's take a synopsis of this. So you need to keep your focus very clear that there are two focus points when you're looking at identification of the accounting acquirer. The focus point number one is, did you create a new company or not? And accordingly, then you say, okay, what is the consideration primarily comprising of? The focus point is, did you create a new entity or not? And the consideration is primarily in which form? So I can see, if you ask me in this chart, there are just three major conclusions. Hear them carefully and just vouch me. If I say the consideration is paid primarily in cash, I said I'm not concerned whether a new entity is created or not. It is definitely not a case of reverse acquisition. Who paid cash is the legal and the accounting acquirer both. So you're very safe when the consideration is primarily in cash. You can outrightly say that the company which paid cash is the legal acquirer and the accounting acquirer both. It would be a case of normal acquisition accounting. Second, if the consideration is paid in the form of shares, I'll say, okay, did you create a new entity? No. Okay, then let me evaluate the percentages and identify that whether it is a case of reverse acquisition or not. The example which I gave you. Okay, I said, okay, number three, did you create a new company? Then let me tell you, generally, the new company cannot be the acquirer because the shares of that company is given to the shareholders of the existing company. So definitely one of the existing companies would generally be the accounting acquirer. In this case, it is undoubtedly a case of reverse acquisition. So if the consideration is primarily in cash, not a reverse acquisition, acquisition accounting. New company is created with equity shares as a consideration, 100% a reverse acquisition, and new company not created, equity shares component, depends. Make the calculations and decide. Right, friends? I hope I am pretty clear so far at this stage. Okay. I guess, Kaushik, you said how existing company becomes an accounting acquirer. Would new company be the accounting acquirer? Okay, as I said, let's give you a simple example. Let's say a new company is created. The company A is got 100 shares in the company B is got Right, friends, my apologies. I think there was a little electricity cut at this stage. It's, I think, got too technical even for the electricity to bear all that technicalities. Don't worry, I'll just repeat the inputs, what I discussed. I think there was a question which you asked me regarding the fact that how do you say that in situation, how do we say that in this particular situation, when a new company is created, how would I conclude that it is supposed to be a case of reverse acquisition? So as I said, just assume a very simple case where the company A is got, let's say, 100 shares and the company B is got, let's say, 60 shares. And if, let's say, the ratio of exchange is 1:1, the company AB lands up giving one share to, for every one share to A and B. So the total shares of the company AB is going to be 160. So A is got 100 shares out of 160 shares. He gets a 62.5% stake. So you can say effectively the company A is got a 62.5% stake in AB and B is got a 37.5% stake in AB, which implies what? That A is effectively getting a control over the new company AB. Now, since the shares of the new company is going to go either to the shareholders of A or to the shareholders of B, so naturally, as a logical conclusion, one of the existing companies only can get a control over the new company. So in this case, it would generally always be a case of reverse acquisition, right? I guess that clarifies your question, I believe. Okay, I think Rahul, you said, so why in case of a new company, it is always a reverse acquisition when shares are issued? Could you elaborate? I think you got your answer at this stage now. That why I'm saying that a new company would always mean a reverse acquisition, because the shares of the new company would either go to the shareholders of A or it'll go to the shareholders of B. So effectively, either one of them gets more than a 50% stake. So it could be possible that, both the shareholders get an equal share or something, but generally considering that A gets a larger number of shares in case of B, in effect, he gets a control. So it will always happen that one of the existing companies in this case becomes a case of, you can say, league accounting acquirer. Okay, clear, wonderful indeed. So as I said, I'm just giving you three conclusions, which I just gave you, and at that time there was a little cut. So number one, I can say if the consideration is in cash, it doesn't make a difference to me whether a new company is created or not. I would say, yes, it is a normal acquisition accounting. Number two, if a new company is created and equity shares is the consideration, I would say it is a reverse acquisition. And if new company is not created and the consideration is shares, you need to evaluate the percentages. It may or may not be a case of reverse acquisition. Right. So far, so good. I guess now let's take you to some questions on this. So you're going to help me. Let me just take you to the assignment. And we're going to look at a few questions on step number one. So let me just take you to a small little question. So this is the assignment. I'll be sharing that assignment also to you. Let's have a look at question number 4. I guess this is visibly clear. Okay, let me just read this question to you. And of course, you said A will be a legal and account. Okay, you said AB will be the legal acquirer. Yes, absolutely. In my example, you can say, yes, AB is the legal acquirer, but A becomes, you can say, the accounting acquirer. Okay. Let's have a look, first of all, on question number 4. And let me just read the facts and then you can vouch me on the answer. It says Veera Limited and Zira Limited are both in the business of manufacturing and selling of lubricant. It says Veera and Zira shareholders agree to join forces to benefit from lower delivery and distribution cost. And it says the business combination is carried out by setting a new entity called Mira. Focus 1. So very clearly you're given in the question that a new entity Mira is being created. Let me ask you, Can I outrightly say that in this case, it would happen to be a reverse acquisition provided the consideration is in the form of equity shares? Would that be technically correct to say? I would say yes. Okay, let's see further. So a new company is being created. And I think that's it. Nothing else is given. Oh, did we miss out on any part on this? Okay, I think there is some missing link, maybe due to the fact Elixir went off. I think something got edited out. So I think this question is also there, I guess, in the study material as well. So let me take you to the study material instead. Let me just come to the question in the study mat. No, I'm afraid it's not out here. Anyway, I think we'll do another question. Let's do another question with you. Somewhere it got, I think, disconnected. So this question has got slightly disconnected. Okay, I think I need to add another question. There's another very interesting question which is given in the study mat. Let me just take you there. Just give me a second. Okay, I think we'll just pick up one question from the study material itself, because I've just missed a lot that particular question. So let's give you a question from the study material. So let me just take you to a question of the study material from the assignment. I think, I don't know, somehow it got deleted. Let's take a simple example with you. So let me just read that question out to you. So there is an example which is given in the study mat. Let me just take you to that example. So we are given in this particular case, company A and company B operate in the power industry, and both entities are operating entities. It says A has got much larger scale of operations than company B. Company B merges with company A such that the shareholders of B would receive one equity share of company A for every one share in company B. It says such issue would comprise 20% of the issued capital of the combined entity. Though in this particular case, we are not given the status of the number of shares of A and B, but we are given that post the business combination, you can say when A issued the shares to the shareholders of B, naturally company A dilutes the control, and then it tells you that the number of shares which are given to the shareholders of B comprises 20% of the issued capital of the combined entity. So what does this mean? Can I say if the shareholders of B gets a 20% stake in the company, the shareholders of A in effect have got an 80% stake in the combined entity. That means even after issuing the shares, it is still in control of that company. So it is definitely a case of acquisition accounting. So in this transaction, we can say after the discharge of the consideration, the pre-merger shareholders of A has got 80% capital in A. So as I said, if the consideration is in equity shares, you need to do the pre and post business combination percentages. So they've done that calculations already. In this transaction, A is the acquirer for the purposes of accounting for business combination as per 103. This is because by merging the entire shareholding of company B, A has acquired a control over B. Further, the shareholders of the erstwhile company do not obtain a control over A. On account of shares received as the consideration, they've got only 20% of the paid up capital. So I think I've already given that point to you with an example. Okay, so this is step number one, which has got no complications. You just need to watch out that in this particular case, What is the status? Did you create a new company or not? Focus 1. What is the form of consideration? Focus 2. Okay, so far so good. I guess let me see any questions coming to your mind. Okay, clear so far. Okay, now let me go to the step number 2. Now, having understood the step number 1, let me now take you to the step number 2. Now, the step number 2 is identifying the date of acquisition. And that's not going to be a technical step at all, identifying the date of acquisition. But there is something very interesting which I want to tell you at this stage, because we'll do a couple of questions also on that area. So hear me very carefully. When I say that we need to identify the date of acquisition, that is what I call DOA, date of acquisition. 99% of the questions, you will be given a date of acquisition directly. But let's say if you get an independent small question identifying the date of acquisition. Now, be very careful on what I say. The words need to be heard very carefully. Number 1, when I say date of acquisition, it is the date when control is obtained. So we say, what is a date of acquisition? We say the date when the control is obtained. That is called the date of acquisition. Number 2, mind it, number 2. So when I say date of acquisition is the date when the control is obtained, there is another date which is called a closing date. There is another date which is called a closing date. So what is a closing date? The closing date is when the consideration is discharged. Let me put it out here. When the consideration is discharged. So mind you, I'm giving you two concepts. So I'm giving you two concepts. Hear this very carefully. I'm saying there is a date of acquisition. I said, what is a date of acquisition? I said the date of acquisition is when a control is obtained. Then I said there is another date which is called a closing date, and the closing date in when the consideration is discharged. Ideally, I am saying ideally, these two dates need to be the same. So I'm saying ideally, mind the words very carefully, ideally, they are same. So ideally, these dates are supposed to be same. The date when we say the consideration is paid coincides with the date when the control is acquired. Mind the words carefully. So I'm saying if somebody says what is a date of, it is possible that a company gets a control before the consideration is paid. You heard it correct. There is an exception. There is an exception. That exception is that the company could obtain a control before the consideration is paid. In an idealistic situation, you get a control only when you pay a consideration. But there is an exception that you may get a control and that precedes the consideration payment. In this particular case, the date of acquisition is the date when you got a control. So we can say there is a small little exception. And the exception is that control can be obtained. Control can be obtained. So the exception is control can be obtained before. I underline the word before. The control can be obtained before the purchase consideration is discharged. So how is it possible that a company gets a control before the consideration is discharged? This is possible if there is a mutual agreement between the acquirer and the acquiree. The acquiree passes on the control to the acquirer before the consideration is paid. So this exception will get triggered. This exception will get triggered if there is a written agreement, and by virtue of the written agreement, the acquiree passes on and tells the acquirer that, okay, you've obtained a control even though you're yet to pay a PC. So once again, and I'll tell you, don't worry, we'll take examples to make it very clear. I'm working on the step number 2, that if you get an independent question on identifying a date of acquisition, you need to know the nitty-gritties. Otherwise, as a part of the larger question, the date of acquisition would always be directly given in the question. So what you need to keep in mind is that there are 2 different dates. One is called a date of acquisition, and one is called a closing date. So we're looking at 2 dates differently. One is an acquisition date and one is a closing date. Now, if somebody says, what is an acquisition date? I say when control is obtained. If somebody says, what is a closing date? I would say when the consideration is paid. I would say, are the 2 dates different? I would say, no, generally, the 2 dates are not different. The date when you obtain a control and the date when you pay the consideration coincides with each other. So generally, the closing date and the date of acquisition is always same. But there is a possibility, there is an exception where the acquiree and acquirer, by a written agreement, the acquirer obtains a control even before the consideration is paid. In that case, the date of acquisition precedes the closing date. And the only example which is given in the index is that this can happen when the written agreement, passes on the control. Let's have some look at questions on this area. So let me see if any questions coming so far in between. Okay. Janvi said, can control pass after the consideration? Wow. So you mean to say that is it possible that the date of acquisition succeeds the closing date? Well, technically, you can say yes. But IFRS, if you look at Index 103, there is a slight reference on that. If you look at the US gaps, there is definitely more reference on that. But from the examination point of view, I'll not discuss the third case, but yes, there is a possibility. And the concept is being defined under US gaps as a convenience date. Even if you look at the education material, there is not much guidance on that. But I think even if you look at the US gap, the third kind of a combination is a very rare kind of a circumstance. But yes, it is possible that the consideration has already been paid and still you've not obtained a control. And yes, it is possible. This is a concept which is given in US gaps and it is called a convenience date. I'll not get into more than that. So from the examination point of view, you can say there are 2 combinations only. The date of acquisition coincides with the closing date, 1. The date of acquisition precedes the closing date, 2. So date of acquisition succeeds a closing date is something not meant from the examination point of view and a very rare kind of circumstance even from the practical point of view. Okay. So let's now go to the assignment. Let's have a look at some questions on acquisition date with you. So let me just come back to the assignment and let's have a look at 2-3 questions with you on this area. So this is the questions on the date of acquisition. So let's have a look at the question number 6 with you. Okay, so let me just read the question to you and we'll identify the answer. Now look at the language very carefully. Let me slightly zoom it further. Okay, so let me just read the question to you. It says, can an acquiring entity for a business combination based on a signed non-binding letter of intent where the exchange of considerations and other conditions are expected to be completed within 2 months? He's asking me that is there a possibility if the 2 parties, acquirer and acquiree, have signed an agreement, but it is a non-binding letter. So the consideration will be paid 2 months later. So they signed an agreement today. It is a non-binding agreement and the consideration will be paid 2 months later. So can I consider the date of signing of the non-binding letter of intent, a letter of intent, to be an acquisition date in this case? I think since it is a non-binding letter of intent, the word non-binding is telling me that I don't think so we can consider this to be a date of acquisition. If you're passing on the control to the acquirer, it has to be without any ifs and buts. In this particular case, it should be a binding agreement between the two. So a letter of intent which is non-binding on the parties cannot trigger that you obtain a control before the consideration is passed. So in this particular case, the answer would be no. The reason and the logic is simple, that it's a non-binding letter of intent. Let's see another question. It says on 1st April, X Limited agrees to acquire the shares of B in an all equity deal. The consideration is totally in the form of shares. Then he says, as per the binding agreement, the word is very clear, as per the binding agreement, X will get effective control on 1st April. However, the consideration will be paid only when the shareholders' approval is received. So it says there is a binding agreement and the control is being passed on 1st April, but the consideration will be paid only when the shareholders' approval is received. The shareholders' meeting is scheduled to happen on 30th April, 1 month later. If the shareholders' approval is not received for the issue of new shares, then the consideration will be settled in cash. It says, what is the date of acquisition? Now, let me give you some analysis. Can I say in this case, the deal is subject to the approval of the shareholders, but do you think that this approval is of a very important factor? We are very clearly given the fact that even if the shareholder approval doesn't happen, it only changes the form of the purchase consideration, but that doesn't mean that the deal will go. So we can say that this approval is something which is not substantive in nature. Because if the approval is such that, if the approval doesn't happen, the deal is going to be called off, then we can say that the approval is definitely substantive in nature. So in this particular case, since we can say that as per a binding agreement, the control was passed on 1st April, and it is though subject to the approval of the shareholder, but even if the approval is not obtained, the deal is still on. It's only that the consideration instead of equity shares is going to be paid in the form of, you can say, cash, but the deal is not going to be called off. So I think we can safely assume that the date of acquisition in this case is 1st April and the closing date for your reference. The closing date for your reference, the date when the consideration will be paid and the shareholders' approval is obtained, is 30th April. So, sir, can we make a conclusion in the mind, something like this, that we can say, number one, if there is a non-binding letter of agreement, then of course the closing date and the date of acquisition is same. Make sense? Can I say if there is a binding letter of agreement, then it depends that whether the approval is subject to approval or not. If it is not subject to any approvals, then yes, the date of acquisition proceeds. But if you say that it is subject to approval, then I would say that, okay, is this approval something which is just procedural in nature, that it would not make any effect on the deal? Then I would say the date of acquisition proceeds. Don't worry, I'll make that chart as well. But if you say that the deal is subject to approval, which is substantive in nature, then I think you cannot consider the date of acquisition preceding the closing date. Let's look at another example. Let's have a look further and let's look at question number 8. There are 2 questions now in the education material which will give you a very good insight on this concept. I'll consolidate the learning on that. It says ABC acquired all the shares of XYZ. The negotiations commenced on 1st January X1 and the agreement is finalized on 1st March X1. Negotiations started on January, finalization took place on 1st March. While ABC obtains the power to control XYZ on 1st March X1, the agreement states that the acquisition is effective from 1st January and ABC is entitled to all the profits after 1st January. In addition, the purchase price is based on the net assets on 1st January. What is the date of acquisition? A very interesting case. A company started negotiations on the 1st of January, but the deal got finalized on 1st March, and then they are trying to do a retrospective effect. by an agreement made on 1st March, they are pushing things with a retrospective effect and telling that you can get a control. It says, though you obtain a control on 1st March, but the agreement is effective from 1st January, you get the profits thereafter. The consideration is based on 1st January. Do you think all that would make a difference? If the control comes on the 1st of March itself and you're trying to push the dates back, you're trying to tell the acquirer that, okay, we'll give you profits with effect from a retrospective effect. The institute in the education material clarified that no, you cannot say that the control comes earlier. Even if you pass on the profits 2 months earlier, even if your consideration is based on the position on 1st January, that doesn't make a difference. The control in this case is going to be 1st March itself. Because control came on a particular date, if you push things backward, it doesn't make a difference to the analysis. Let's look at another example, then I'll consolidate the picture. Let's have a look at another example. This is a very interesting one. Question number 9, this is again from the education material. Let's have a look on this. It says in question number 9, ABC and XYZ are manufacturers of rubber components for a particular type of equipment. ABC makes a bid for XYZ business and the Competition Commission of India announces that the proposed transaction is to be scrutinized to ensure that the competition laws are not breached. Even though the contracts are made subject to the approval of CCI, ABC, XYZ mutually agree the terms of acquisition and the purchase price before the CCI clearance is obtained. Can the acquisition date be the date when they agree to the terms, even though approval of the CCI is awaited? And it says, assume that the approval is substantive in nature. I think let's get the answers from your side. They made an agreement, but that agreement is subject to approval, and the approval is something which is substantive in nature. And if it is substantive in nature means that if you don't get the approval, the deal is going to be called off. Do you think we could consider that the control was obtained before the approval of the Competition Commission? What do you say? Do we consider that by virtue of the agreement they've decided to pass on the control, would they be able to effectively say that the acquisition date precedes the date of, you can say, closing date in this case? Let's see your answers in this case. So what do you say in this particular case? Can I consider that this is a case where the date of acquisition precedes the closing date in this case? Or can I say, no, it cannot, considering the approval is substantive in nature? Okay, that's absolutely correct. So we can say, no, it cannot proceed because it is substantive. That's wonderful indeed. Now, let me just consolidate the picture. In terms of the learning, let's give you a little more intricate chart on the step number 2. So let me just consolidate the picture back to you. So I've already given you some notes on the step number 2, but let me just quickly do some more additions on the step number 2. Let's give you a wonderful chart combining the discussions in this chart. So we're looking at the step number 2. If you get an independent question on identifying a date of acquisition. If you're looking at a date of acquisition, so what is the thumb rule and what is the exception? Let's recall that once again. So I can say the thumb rule, I can say the basic thumb rule is that date of acquisition is equal to what we technically call a closing date. This is the thumb rule, that your acquisition date and the closing date is same. So what is the date of acquisition? The date of acquisition is when control is obtained. When the control is obtained, this is the date of acquisition. I said, okay, what is the closing date? I said the closing date is when the purchase consideration is discharged. So we said the thumb rule is you get a control when the consideration is paid. That is the thumb rule. Though the two dates are different, date of acquisition is one, Closing date is another. This is the date when control comes. This is the date when the PC is discharged. This is a thumb rule. But I said there is an exception. I said there is an exception to the thumb rule. What is the exception? The date of acquisition precedes. Date of acquisition precedes. You can say the closing date. This is the exception. So I said the date of acquisition can be before. I'm not talking of after, because that possibility we've ruled out from the examination point of view and more or less even from the practical world point of view. So I said the date of acquisition precedes. You can say it precedes the date closing date. I said, okay, let's get it clear. When does this happen? When there is an agreement. So I said, okay, let's make some permutation combinations that there is an agreement. If there is an agreement, we can say, but is the agreement enough? Is the agreement enough? I would say, okay, let's look at like this. The agreement passes on the control to you, and let's say the agreement is not subject to. It is not subject to approval. That's one case. Let's consider the agreement is subject to approval. Let's consider it is subject to approval. So these are the two permutation combinations which can happen. That the agreement is not subject to approval. If it is not subject to approval, I think the control definitely passes on. So in this particular case, I would say yes, the date of acquisition precedes. The date of acquisition definitely precedes the closing date in this case. If it is subject to approval, I will say, okay, put across a question to yourself that is the approval merely procedural in nature? Or is it something which is substantive in nature? I need to see that is the approval merely procedural. Like, for example, the question which we did where the shareholders' approval was required, I would say it was merely procedural. Because when the shareholders would not even approve, the deal is not going to be called off. It's only the consideration is paid in cash instead of shares. So if it is procedural, I would say in this case, definitely it can precede the date of acquisition. But in the example of the Competition Commission, I would say if the approval is something which is substantive in nature, then I can say the date of acquisition cannot precede. The date of acquisition in this case cannot precede, you can say, the closing date. I guess the permutation combinations are very clear. This is the crux in terms of my step number 2. So you need to watch out in a question that in a very idealistic situation, the date of acquisition and the closing date is same, though conceptually they are different dates, because this is when control comes and this is when the PC is paid. But the control can come before the PC is paid as well. So we need to watch out that if by an agreement, the acquiree gives a control to the acquirer and it is not subject to approval, acquisition date proceeds. Approval is required, but it is merely procedural, acquisition date proceeds. But if it is something which is substantive in nature, then you need to wait for the approval. The date of acquisition will be only once approval is obtained. Right, friends? So this is step number 2. I guess the 2 steps were quite theoretical in nature, but I think you would have got your conceptual clarity. Let me, I think, get your comfort zones at this stage before we get into a little more technicalities at this stage. I want you to give yourself an assessment on a scale of 10. What is your comfort zone on a scale of 10 so far on what we have covered on the 2 steps today? Let's see what is your comfort zone, and accordingly, let's take it further. Okay, so that was an answers coming in. Binding, not substantive. Approval is pending. Okay, that's wonderful indeed. So I guess let's get your comfort zone score, friends. It helps me to understand your psychological understanding as well. Helps me to, give things for the coming part. Okay, so this is step number 2 is done. Now I'm going to go to the step number 3. Okay, I think I got 1 score, and that's 10 out of 10, Kaushiki. That's wonderful indeed. And what about my other friends? I think you're taking some time to make your self-assessments done. I know it's very difficult, to make an assessment of your own on yourself But I think if your understanding is there, you can at least make some kind of an assessment. It would be appreciated if I get some kind of an assessment on your part on the acquisition date and on the identification of the accounting acquirer. Okay, I think we got 8 from Namrata as well. Okay, that's wonderful. So only 2 scores coming in. Rest, I think it's very difficult. I know it's easy to assess others, very difficult to assess yourself. Okay, so let's begin the journey, friends, now on step 3. Now, this is going to start a little technical journey. Now, on step number 3 onwards, it's going to be slightly a little technical journey. So watch this very carefully. From here, the discussion is going to take a little higher level, but trust me, you'll understand everything. You need to keep your eyes and ears open. That's the terms and condition. Let's begin. The step number 3, as I said, is making a list of net assets. But I am now giving something new in terms of step 3. The step number 3 is going to comprise of 2 sub-steps. One is a substep number A and a substep number B. Now, you need to be very careful when you read a question. You need to see that in the question, a tax rate is given or not. When you look at the question on a business combination, you need to watch out carefully that are you given information on a tax rate in the question or not. If there is no information on a tax rate, I am saved with the trouble of applying Ind AS 12. But if you're given a tax rate information, you are now on and you need to apply the aspect of Ind AS 12 as well. You've already done Ind AS 12. And in terms of Ind AS 12, you've seen some exceptions regarding the business combination as well. If you recall, the exception was with regard to the goodwill. Now, watch me carefully, friends. I'm now going to give you a very important input on step number 3A. So before we go to the step number 3B, I'm first taking you to the step number 3A and hear this very, very carefully indeed. In terms of the step number 3A, what do you need to do? Just focus on the entry, that is the acquisition entry. Even in this attempt in May 23, there was a wonderful question on the business combination, standard, a very good question indeed. Okay, so if you look at the acquisition entry, what was the entry? The entry is assets debit, liabilities are given a credit, and a purchase consideration and the NCI is given a credit. Now, let me make one thing very clear. When you do an acquisition accounting entry, in the acquisition accounting entry, you need to record the assets and the liabilities at fair value. You need to record the assets and liabilities at a fair value. So I'm telling you in advance in step 3 that as a part of the acquisition accounting entry, all the assets and liabilities are going to be recorded at a fair value. Now, the moment they are going to be recorded at a fair value, what is the implication? The implication is that the carrying amount is equal to the fair value. If you have recorded the assets and liabilities at a fair value, you can say the carrying amount is equal to the fair value itself. But if you look at the tax base, the income tax authorities, for example, in terms of assets, will not give you a deduction more than the original cost of the asset. So let's say, for example, there is a land. So in this acquisition entry, you took a land at a fair value. So when you took the land at a fair value, it becomes a carrying amount for the purposes of Ind AS 12. But as far as the tax base is concerned, when you go to sell the land, for the purpose of calculating the profit on sale of the land, the income tax authorities will give you a deduction equal to the original cost of the land. So they will give you a deduction equal to the original cost in case of land. So what will happen? The carrying amount of the asset and the tax base of the asset or even liabilities may not be same. So the carrying amount and the tax base will be different. And if it is different, it would lead to, you can say, a timing temporary difference, which could be either taxable or deductible, leading to a DTA or a DTL. The question rises, would the DTA and DTL be recorded as a part of this entry? Yes. So I'm not talking of goodwill, friends. I'm not talking of goodwill. I'm talking of the net assets other than goodwill. I'm talking of the net assets other than goodwill. So if the net assets other than goodwill are taken at a fair value, the tax base and the carrying amount would differ, resulting in a deferred tax consequences. And this DTL or this DTA is going to be recorded in this entry itself. So whatever deferred tax asset or deferred tax liability arises out of these assets and liability other than goodwill are going to be recorded in this entry itself. So what do you need to do? If you're given a tax rate in the question, you need to first of all make a chart. Apply Ind-AS 12 and see what is the carrying amount, what is a tax base, get the deductible taxable differences, get the DTA and DTL on all those assets and liability whose fair value and the tax base is different. Then comes the caution. If you get a goodwill as a balancing figure, if you are going to get a goodwill as a balancing figure, you need to watch out, does it lead to a DTL or does it lead to a DTA? Because you've taken care of the deferred tax on the net assets other than goodwill. You've taken care of the deferred tax on the net assets other than goodwill. Then you need to see that goodwill, which is a balancing figure, results in a DTL. You already know that if it results in a DTL, you cannot recognize it in this entry. The reason you know is a circular effect. But if this goodwill is resulting in a DTA, you're going to put this in this entry. So basically, you'll have to take care of the deferred tax implications. You would say, sir, can you take an example and illustrate the deferred tax implications on the acquisition accounting entry? Yes, of course. I'll take an example also to illustrate the picture, but let's get one thing very straight. So as a part of the step number 3A, what do you need to do? You need to carefully, first of all, consider, when you go through this step, what do you need to do? You need to consider net assets other than goodwill. You need to consider the net assets other than goodwill. So if there are net assets other than goodwill, it results in a DTL. Do we recognize? Yes. It results in a DTA. Do we recognize? Yes. Get this very clear. So if there are net assets other than goodwill resulting in a DTA, DTL, calculate the figure. Next, if I'm looking at a goodwill, if there is a DTL on account of goodwill, not to be recognized. If there is a DTA on account of goodwill, to be recognized. So you need to get a chart made, and you need to get a chart made that if there are deferred tax asset liability or net assets other than goodwill, calculate them. If there is a goodwill resulting in a DTL, ignore. If there is a DTA, consider. This is the first exercise we need to do in step number 3A. Right, friends? I hope I am pretty clear on this part. Now, let's do one thing. I'm now going to first of all take you an example so we can get a fair idea on the application of deferred tax on this entry. Though I know it's too early to take you to acquisition accounting, but let's, I think, look at a simple question and let's get a little flair on how this entry will be done if deferred tax implications are given, because you can get an independent question on this area as well. Okay, so let me just add, I think I just need to add the assignment, I guess. Just give me a second, because the Lexity, you know, it just went off. So I'm just adding the assignment now. I think the missing questions would come now. Yes, I think the missing questions are there now. Yes, I had put in these questions. So I'm taking you to a question which came in the RTP in November 2020. So let's have a look at one of the questions which came in RTP November 20. Similar kind of questions can be seen in the study material as well. So let's have a look at this question. The focus is only on step number 3A at the moment. Let's have a look. Let me just read the question to you. So we are given in this case It says on 1st January 2020, company H acquired 100% capital of S for 15 lakhs. It says the book values and the fair value of the assets and liability at the date of acquisition is set out below, together with the tax base in S tax jurisdiction. Any goodwill arising on acquisition is not deductible for tax purposes. It says goodwill is not deductible for tax. That means the tax base is going to be zero, right? So if the goodwill is not deductible for tax purposes, that means the tax base, which is equal to the future deduction, is zero. So the carrying amount is going to be greater as compared to the tax base, which would mean a taxable temporary difference resulting in a DTL. But the standard says in this 12 that you cannot recognize a DTL on a goodwill. So no worries. The tax rate in H and S jurisdictions are given. So what we're given is the book value, the tax base, and the fair value. Now the question arises, if I am applying Ind AS 12, in step number 3A, I'm applying Ind AS 12. So in terms of Ind AS 12, my step number 1 is to calculate a carrying amount. So the question rises, is the carrying amount the book value? Or is the carrying amount the fair value? The carrying amount is equal to the fair value. The carrying amount is the fair value. So you can say this is the step number 1. So you are given the carrying amounts of the assets and liability. That is supposed to be step number 1. I go to the step number 2. And in terms of the step number 2, you need to calculate the tax base. And you are already given a tax base. The tax base is already given in the question. So what about this column? Is it redundant? Yes, it is redundant. I don't need information of this column because the carrying amount is equal to the fair value and this is the tax base. Then you need to compare the two and you need to go to the step number 3. And in terms of the step number 3, you need to get a temporary differences classified as taxable or deductible in nature. Let's make a comparison 1-to-1. For land and building, the carrying amount is greater, means a taxable temporary difference. For property, plant, equipment, the carrying amount is greater, means a taxable temporary difference. For inventory, you can see the tax base is greater. This would mean that there is a deductible temporary difference. Then account receivable, you can see it is the same value, so no deferred tax implication. Cash and cash equivalents is again the same, no deferred tax implication. Accounts payable is also the same, no deferred tax implications. In terms of retirement benefit obligations, the carrying amount is more. For a liability, if the carrying amount is more, it becomes a deductible temporary difference. So can you see that I am applying Ind AS 12 to the net assets other than goodwill, comparing the carrying amount and the tax base and identifying taxable or deductible temporary differences. So let's do one thing. Let's club the figures. So we've got a taxable difference of 200 as well as 70. So let me note it down. There is a taxable temporary difference to the extent of 270. There is a deductible difference of 20 as well as 100. So there is a deductible temporary differences to the extent of 20 plus 100, that's 120. So I've just added up the taxable differences on one hand and the deductible differences on the other. Let's say if you can set them off, you can say the net taxable temporary difference, which I'm getting, is to the extent of 150. So this net taxable differences would result in a DTL. So we apply the step number 4 and we get what is the DTL. So you need to multiply this with a tax rate, and the tax rate which is given is 40%. So 150 into 40% is 60. So we get a DTL. And if you want to look at the step number 5, if in terms of Ind AS 12, you go to the step number 5 and I say, okay, where are you going to recognize this? Let me take the liberty of asking you that question. Are you going to put this in the P&L? Are you going to put it in the OCI? Are you going to put it in the SOCI? Or are you going to put it through the acquisition entry, resulting in a goodwill change? I guess you remember that if it is a business combination, then any kind of deferred tax gets recorded in the acquisition entry. So this will get recognized by way of goodwill itself, because I'm going to pass the entry and you're going to see the impact. So this is what you need to do in every question of business combination if a tax rate is given in the question. The moment you're given a tax rate in the question, you need to first of all apply Ind AS 12. Make a comparison. The carrying amounts are the fair values, the tax base, get the taxable deductible differences, get the associated DTA, DTL, and record it in the entry. So let's say if I want to pass an entry in this particular example, let's see what is the entry I'm going to pass. So I think I'll need the figures. I'll just open the question in front of me and take it further. So in this particular case, let me see the entry. Let me just shorten this to pass the entry. Or maybe I think let's do one thing. Let's keep it here. Let me just add another page. So let me now put the journal entry which I'm going to pass. So let's see in the same question, what is the acquisition entry? Let us see what is the acquisition entry in this case. So the acquisition entry is I'm going to put things at a fair value. So let's consider land and building debit. Let's consider the fair value. The land and building is given at 700. The next item is a property, plant, equipment, also recorded at a fair value. And this is 270. Then there is inventory also to be recorded at a fair value. There is an account receivable also recorded at a fair value. So the inventory is got a fair value 80. The account receivable is got a fair value, which is 150. So these are the assets recorded at a fair value. And then we've got accounts payable. We've got the retirement benefit obligations. So we've got retirement benefit obligations. So these are liabilities. And this is given to me, it is 160 and 100. So we have taken all the assets and liabilities at a fair value in the acquisition entry. And as far as the purchase consideration is concerned, it says we acquired things at 15 lakhs. So 15 lakhs in terms of thousands would mean 1500. This is the purchase consideration. You've acquired 100% of the shares. There is no NCI. So we've done in the entry assets and liability. So what else do you need to put in this entry? The DTL which we calculated, on the net assets other than goodwill, that was to the extent of 60. These figures are all in terms of thousands. And goodwill, he's already said that DTL on the goodwill is not deductible. So we're not going to recognize the DTL. So I think now we can see the balancing figure. Let's see what is the balancing figure in this entry. And that balancing figure is going to be taken as a goodwill. So let's see. So the credit side is 1560 plus another 260 and minus the assets. And I think this is coming to a figure of, I think, 620 or something. Let me just, I think, quickly calculate this. This is coming to, this is credit side 260, 1500, that is 1760. Did I miss out anything? 700 is done, 270 is done, 80 is done, and 150 is done. I think I missed out one item. That is cash and cash equivalents. Missed out the cash and cash equivalents on the debit side. The cash and cash equivalents is 130. Okay, now I think we get the correct answer. So 1560 plus 260 minus 150 minus 130, 80, 270, and 700. Yes, we're getting a balancing figure 490. That is the goodwill. So this was an application in terms of the step number 3A, which is purely an application of Ind AS 12. So the moment you are given a tax rate in the question, be a little careful that the moment you're given a tax rate, you need to go in for the application of Ind AS 12. Right, friends? I hope this part is pretty much clear, friends, out here. Okay, so Janvi, you said, so in this case, there are two tax rates which are given. Yes, you're right. There are two tax rates given, but since we are looking at the assets and liabilities of the subsidiary, we need to consider the tax rate of the subsidiary company itself. The parent tax rate would be irrelevant. So therefore, we've taken 40% for the purpose. Okay, so far, so good. Now, let me just come back. So let me just come back on the step number 3. So before we give you further things, let's just quickly consolidate the position in terms of step number 3A. So the moral of the story is, when you're looking at step number 3, there are two steps to be considered. One is step number 3A and one is step 3B. I'm yet to discuss step number 3B. But what do you do in terms of the step number 3A? In terms of step number 3A, watch out, is the tax rate given in the question or not? If there is no tax rate, you're saved with the trouble of applying any deferred tax implication. But if you're given a tax rate in the question, then what do you need to do? Do two separate exercises. First of all, look at all the net assets other than goodwill. Get your focus clear that you need to first of all look at all the net assets other than goodwill. That is one. Any deferred tax asset or liability on net assets other than goodwill is going to be taken care. And the DTA or DTL will be a part of the acquisition entry itself. Number 2, then you must have a look at the goodwill, that is it resulting in a DTL or DTA. If the goodwill is resulting in a DTL, you cannot take it in this entry. It's not incorporated, it's not recorded. But if it results in a DTA, then you are going to record it in this entry. So get your deferred tax calculations as we saw in the question. After you get the deferred tax figures with you, then you go to the step number 3B. Okay, so far so good. I think it's time now that we give you a little break as well. I'm sure you'll need one. So we'll just take a break and then we'll start concentrating on the step number 3B, which is a very crucial step because that is making a list of the net assets. And there are a couple of exceptions which are given in the standard. I'm going to talk of those exceptions with you after the break. So let's see if there are any questions coming so far. Otherwise, I think we'll take a 10-12 minutes break. Okay, Janvi, you said, so fair value of inventory is supposed to be 100. Fair value of the inventory is not 100, it's 80. The tax base is 100. Fair value of the inventory is 80, and I think I took that 80 itself, right? Okay, so I think, friends, it's almost around 8:45. So we're just going to take a quick 10-12 minutes break, friends, with you. And then I am going to start after the break. So enjoy a break. See you in 10 to 12 minutes time. Welcome back, friends. I guess you had a little relaxation of the mind as well. I think there is a small question before I proceed further. Let me answer that. Pranav, you said, so in case of reverse acquisition, whose tax rate will we take, a legal acquirer or accounting acquirer? Well, at the moment, we're not going to talk of a reverse acquisition because I will discuss the acquisition accounting, then we'll come to the concept of reverse acquisition and then common control. So I think let's not mix the reverse acquisition at this stage. Bear with me for some more time after we're done with acquisition accounting. Okay. So far, what we have done out of the 7-step model with you, I have covered the 2 steps with you, rather I would say 3.5 steps with you, where we had a complete focus in terms of the identification of accounting acquirer, for which I gave you a chart. And then I focused on the date of acquisition, and where I gave you the focus again in terms of a chart, making a comparison in terms of the date of acquisition and the closing date. Then I went to the step number 3, and in terms of the step number 3, I gave you the inputs in terms of Ind AS 12 deferred tax implications. Now we come to the crucial step, that is step number 3B, where we need to make a list of net assets. Now, watch this carefully. This is going to be slightly technical if you want to understand the concept. Well, I think if you just want to remember, then it's not a big deal. But if you want to understand the logics, then it's going to be slightly more technical. So let's get on to this. So I am now taking you to step number 3B. So watch this very carefully, my discussion on step number 3B. So step 3B is basically making, you can say, the list of net assets. It is basically making the list of net assets which are to be taken as a part of the acquisition accounting entry. Now, let me first of all give you a base to understand what we're going to do in terms of step 3. Imagine that this is the balance sheet of the acquiring company. So let's imagine that this is the balance sheet of the acquiring company. Of course, I mean the accounting acquiring. And let's say this is the books of the acquirer. This is the books of the acquirer. And you are putting an acquisition accounting entry. So we are recording an acquisition accounting entry in the books of the acquirer. Now let's get the chain of thought, what we are exactly doing. Now, there would be assets in the balance sheet of the acquiring. There would be liabilities in the balance sheet of the acquiring, and these are recorded at a book value. Now, when I do the acquisition accounting entry, the assets and the liabilities, as I've already said, are going to be recorded at a fair value. So let's keep one basic principle in mind, or you can say a basic rule in mind, that when you look at the acquisition accounting entry, the assets and liabilities which are at a book value in the balance sheet of the acquiring appears at a fair value in the acquisition accounting entry. So that's a basic rule which you need to keep in mind. So things are recorded at a book value. They need to be recorded at a fair value in the acquisition entry. Now, there are a couple of exceptions. So what we need to learn in terms of step number 3B is those exceptions. So I'll now tell you the kind of exceptions which can arise. Watch this carefully. I would say what is in the balance sheet of the acquiring definitely appears in the acquisition entry. Mind the words carefully. Whatever is in the balance sheet of the acquiring definitely appears in the acquisition entry at a fair value. But is there a possibility that assets and liabilities are taken at other than a fair value? Yes. So there is an exception. So we can say the exceptions are number 1. The exceptions is number 1, that the assets and liabilities are recorded in the entry other than fair value. They're recorded at other than fair value, not at a fair value. So what is the basic rule? That you need to record these assets and liability at a fair value. But there is a possibility that these assets and liabilities are not taken at a fair value. So this is technically called measurement exception. This is technically called a measurement exception. So I need to know the list of those items which falls in the measurement exception. In the study material, there has been a wonderful chart which summarizes all the kind of exceptions related to the step number 3B. So if you need to get a strong control over the step number 3B, you need to be very clear on the exceptions, because you know the thumb rule. And the thumb rule is what is appearing out here, what is recognized out here is getting recognized here. Mind my words very carefully. So what is recognized out here is getting recognized out here at a fair value, but there may be a possibility that it is not taken at a fair value, but other than fair value. It's a measurement exception, because the basic rule is at fair value. So when you take it other than fair value, it becomes a measurement exception. Next, the second interesting exception is there are certain assets and liabilities which are not in the balance sheet, but they will get recognized in this entry. Mind it. There are certain assets and liability which are not in the balance sheet, but they will get recorded in this entry and at a fair value itself, or maybe at a value other than fair value. Get it right. So there are certain assets and liability which are not recognized here, but will get recognized here. It is called a recognition exception. Because what is recognized is recognized. It is not a recognition exception, because what is here is there, then it's not a recognition exception. But what is not here gets recorded there is a recognition exception. So we can say there are certain assets and liability which are not in the acquiree's balance sheet, and they are recorded in the entry. They are recorded in the entry and at a fair value itself. So when they're recorded in the entry at a fair value itself, it becomes a case of recognition exception. You know, some people don't get into the terminology and they'd say, no, I don't want to get into the terminology as well. So conceptually, you don't become sound. So I'm giving you the terminology as well, that assets and liability which are here will definitely appear here at a fair value, thumb rule. Assets and liabilities out here appear out here at other than a fair value, measurement exception. Assets and liabilities which are not here get recorded there at a fair value. It's a recognition exception. And what is the third one? Assets and liabilities are not here, get recognized here, but not at a fair value, but other than a fair value. It's both a recognition and a measurement exception. So the third area is the assets and liabilities which are not in this balance sheet, but they appear in this entry and they appear at other than fair value. They appear other than the fair value. So if they appear other than the fair value, it becomes a recognition plus a measurement exception both. Wow, I guess I made my chain of thought very clear. So you need to keep in step number 3, because if you're doing a full-fledged question, you need to be very clear on what kind of exceptions are there, because otherwise I can't handle a complete question. So you need to be very crystal clear in step number 3 that, okay, there is a thumb rule. What is in the balance sheet of the acquiree finds a place in the acquisition entry, and they are taken at a fair value. That's the basic rule. I repeat. What is in the balance sheet of the acquiree appears in the acquisition entry as well, and they appear at a fair value. That's the basic thumb rule. I said, now what are the exceptions? What is in the balance sheet of the acquiree appears in the acquisition entry, but not at a fair value. So measurement exception, because other than fair value. Then we said the second one is what is not in the balance sheet of the acquiree is still getting recognized in the acquisition entry at a fair value, recognition exception. And the third one is what is not in the balance sheet of the acquiree is appearing in the acquisition entry other than a fair value, both a recognition and a measurement exception. Did you get my points very clear, friends? Did you get my points very clear so far at this stage, that we need to look into the recognition and the measurement exceptions in this case? Now, I'm going to take you to the study material where there is a wonderful chart, giving you a crux of all the exceptions which arises in terms of the step number 3B. Then we're going to work upon those exceptions. So let's take you to the study material. And there is a wonderful chart which summarizes the list of all the exceptions. And this is it on page number 13.33. On page number 13.33, you look at the list of all the exceptions which are given in this chart. Have a look at me and we'll make a little count, and we need to discuss these exceptions with you. Then the step number 3 gets done. Okay. So we can see that we are given certain exceptions in this particular list. And if you see the exceptions, see what it says. It says limited to acquisition date accounting. So this is only the list which is applicable to the date of acquisition. It is a list applicable to the date of acquisition. It says an asset or liability which otherwise would not have been recorded gets recorded. So something which is not in the balance sheet of the acquiree is getting recorded in the acquisition entry, which otherwise would not have been recorded gets recorded. So this is called what? Recognition exception. The only recognition exception is one: contingent liability. Trust me, many people have got a major misconception in life. And the major misconception they've got in life is that all the contingent liabilities of the acquiree is a part of the acquisition accounting entry. It's a misconception. People have got a wrong belief in mind that all contingent liabilities of the acquiree company is going to be a part of the acquisition accounting entry. No. We'll see the details. So this is recognition exceptions. Then it says the assets and liabilities are measured at a value other than the acquisition date fair value. So you don't take them at a fair value. When you don't take them at a fair value, it's a measurement exception. And in terms of measurement exceptions, you are given share-based payments, assets held for sale, and reacquired rights. There are a total of 3 exceptions. So do we need to really know that this is a measurement exception or this is a recognition exception? Technically, no. Even if you know the entire list, it's okay. But I think if you can, technically, know that, okay, there is one recognition exception, that there is a contingent liability which will be taken as a part of the entry at a fair value. That's a recognition exception. There are 3 measurement exceptions, items which are already in the balance sheet of the acquiree, but they find a place in the acquisition entry at other than a fair value. So there are 3 items: share-based payments, then there is assets held for sale, that is NCA held for sale, and then there is reacquired rights. So what is the reacquired rights? Don't get worried on that. Then they've also given both a recognition and measurement exception. That is the 3rd category, in which you've got a total of 4 items. That is income tax, already covered in step number 3A, employee benefits, indemnification assets, and operating leaves. So you can see the list of 4 exceptions which are given out here. So the total number of exceptions is 1 + 3 + 4. That makes it a total of 8 exceptions. Wow. So we've got a list of 8 exceptions we need to keep in mind when we put the list of net assets with us, right? So I think it's very easy. It's 1, 3, 4. So somebody says recognition exception 1, measurement exception 3, and both recognition and measurement exception 4. It's not 1 + 3. It's not 1 + 3. It's by chance 1 + 3, but there are 4. You can say recognition, measurement, exception. So if you just quickly recall the exceptions in your mind, I should know that recognition exception is contingent liability, measurement exceptions is non-current assets held for sale. Then there is, you can say, share-based payments and reacquired rights. And then on the recognition and measurement exceptions, 4 list on the item: employee benefits, indemnification assets, operating leaves, and income taxes. Okay. So now we need to understand that based on these exceptions, what kind of thought process I need to apply. So when I look at that contingent liability, which is not in the entry balance sheet of the equity, appears in the entry, acquisition entry, what kind of thought process do we need to apply? So let me now tell you that how I'm going to go about it. I will definitely discuss the contingent liability in step 3B. Income taxes I've already discussed in step 3A. I've already done the income tax discussion in step number 3A, so I've taken care of that. Employee benefits in this particular case will be recorded at a value which Ind AS 19 gives me. I cannot recognize an employee benefits at a value which is other than what Ind AS 19 tells me. So employee benefits will be taken at Ind AS 19 value, done. Indemnification I will discuss. Operating leases, again, I can say this will be something which you can understand after lease accounting. I think you've already covered lease accounting, but there are no practical illustrations on this, so I think I'll not get into deep on the operating lease part. Share-based payments, I will discuss later in step number 4. I will discuss this, but I'll discuss it step number 4, not in step 3B. Reacquired rights, again, I will discuss in step number 4, not at this stage. We will discuss, but in step number 4, assets held for sale will be recorded at the value which is as per Ind AS 105, which is a fair value less the cost to sell. Because when a company records a non-current asset held for sale, it is supposed to be recorded at a fair value less the cost to sell. So in the entry, it's going to be taken at the same value. You're not going to take a fair value. So this will be discussed later. This is 105 value. This is discussed later. Done. So income tax already done. Employee benefits 19. Operating lease we're not discussing much. So I just need to discuss two inputs with you: contingent liability and indemnification assets, basically. So I'll just discuss two things at the moment: indemnification assets and the concept of, you can say, the contingent liability. But let's tell you something more as well. Remember when you did Ind AS 38, that is intangible assets. Companies are not able to record internally generated intangible assets because of various reasons which are given in Ind AS 38. A company is not able to recognize internally generated brands. The company is not able to record quite a lot of internally generated intangible assets because you cannot identify the cost which has been incurred in order to develop these particular assets. The cost is not reliably measurable. But imagine I take over a company and their internally generated intangible assets is supposed to be acquired assets for me. So what is internally generated for the acquiring company is supposed to be, you can say, acquired assets for me. So can they find a place in my acquisition entry? Yes, of course. There have been a couple of questions in the exams where the examiners also, tested us in terms of step number 3B, where he sees that, do we know that internally generated intangible assets, which is purchased for the acquirer, appears as a part of the acquisition accounting entry at a fair value? So we'll take a note of that as well. Okay, so let's now do one thing. Let's get on to a little notes with you, and then we discuss this step in detail with you. So let me just come back to the step number 3B. So I'm coming back to the step number 3B, and now let's get the list clear. This is step number 3B. We're making the list of net assets. We're making the list of net assets. So what do you need to keep in mind? I need to keep in mind that assets and liabilities are recorded. Assets and liabilities are recorded in the journal entry at fair value. Assets and liabilities are recorded in the journal entry at a fair value. Now, we've got certain exceptions. Let's make the list. So we've got certain exceptions, and I'm creating a 3-list exceptions to you. So as I said, we've got one exception. This is recognition. It's a recognition exception. What does a recognition exception means? Is it in the balance sheet of the acquiree? Is it appearing in the balance sheet of the acquiree? No. Will it appear in the acquisition accounting entry? Yes. Get this very clear. What does a recognition exception mean? It is not in the balance sheet of the equity, so it is not recognized, but I need to recognize it. I need to recognize it. And what is the value at which it will be taken? It will be taken at a fair value. Get this position clear. The only exception in this case is contingent liability. We'll discuss this in detail right away. We will discuss this in detail. So you need to know that contingent liability is not in the balance sheet, but it is in the notes to accounts, but it is a part of the acquisition entry at a fair value. Okay, then we come to the second block of exceptions that is called measurement exceptions. That is called measurement exceptions. To make it very clear, is it in the balance sheet of the equity? Is it appearing in the balance sheet of the equity? Yes, it is appearing in the balance sheet of the equity. Is it going to be taken in the acquisition entry as well? Yes, it will be taken in the acquisition entry as well. What is the value at which it would be taken? The value it would be taken is other than fair value. It is other than fair value. So we're going to take this at other than fair value. Get the logics very clear. It is in the balance sheet of the equity and it is to be taken in the acquisition entry. So you will definitely find some additional information in the question on this exception. You'll definitely find some additional information about this in the additional information. In fact, I don't remember the attempt, but there was one of the RTP questions, which is a brilliant question on the step number 3B. There is a question which concentrates on the step number 3B. It was an RTP question. It contains all major kind of exceptions in one question itself. Okay. Now, in terms of the measurement exceptions, when I'm looking at the measurement exceptions, the measurement exceptions we've got is a total of 3 measurement exceptions. One is non-current assets, which is held for sale. The non-current assets held for sale is going to be recorded at a fair value less the cost to sell itself. So if in the equity's balance sheet, there is a non-current asset held for sale, you are going to record it at the same value in the acquisition entry itself, because it is recorded at this value and it would appear in the acquisition entry at the same value. The second is share-based payment awards. And the third is in terms of reacquired rights. It is in terms of reacquired rights. We will be discussing these two, but I'll discuss them later in step number 4 when I come to PC. When I come to purchase consideration, don't worry, I will discuss. I'm not saying I'm not going to discuss. I'm telling you when I'm going to discuss, not in this stage. So we'll discuss these two when I come to the purchase consideration, step number 4. Okay, then comes the other one that is called recognition and measurement exception. It is called recognition and the measurement exceptions. Now see what is a recognition and a measurement exceptions. So let me ask myself a question. Is it appearing in the balance sheet of the equity company? No, it's not appearing in the balance sheet of the equity. Is it supposed to appear in the acquisition entry as well? Yes, it is supposed to appear in the acquisition entry. Not recognized, to be recognized, recognition exception. What is the value at which it is going to be recorded other than fair value? Is going to be other than fair value. So does it also become a measurement exception? Yes. So in this particular case, there are a list of total 4 items which are falling under the concept of recognition and measurement exception. So one is employee benefits. One is employee benefits. This will be recorded based on Ind AS 19. So we're not discussing anything further on this. So whatever is the value based on Ind AS 19, that would get recorded. Then there would be a situation, what we can say, operating lease. And if there is any kind of operating lease, though there is Ind AS 116, so we can just make a reference that Ind AS 116 would decide the parameters. So we're not going to discuss about employee benefits or operating leases in this case. Then there is indemnification assets. Then there is indemnification assets. Don't get worried on what it is. I will discuss this in detail now. So I'll discuss contingent liability. I will discuss indemnification assets. And apart from this, we also have another input as well. And I think what was on the list, I think I just forgot what was one more item, income taxes. Yes, it reminds me, nothing can go wrong in a business combination. You can easily crack a question in the exams very easily. So this is the basic thought process. So what we need to discuss now with you, I am going to make a discussion on contingent liability. And these two are pending, discussed later. And we're going to discuss in terms of indemnification assets. So these are the two areas I'll discuss, and the step number 3 gets done at that stage. Now let's discuss the contingent liability exception and the indemnification assets exceptions. We'll take some examples as well so that the step 3 gets closed, except to the extent of the 2 items. Okay, let's take it further. Now let me see if there are any questions coming in between so far. Otherwise, we'll take it forward. Okay, there is nothing so far. So let's take it further. I guess, friends, so far so clear. Don't worry, I will do a consolidations of our learnings towards the end. I'll give you a quick snapshot in terms of the learnings for the day. But remember, as I told you on day 1, you need to do a cumulative revision of the standard. Class 1 revised, class 2 now revised 1 plus 2, class 3 revised 1 plus 2 plus 3. Because there are so many inputs you need to remember, and those crucial points are going to be very important when you pick up a larger question. Okay, let's begin the journey, and let's now work on the exceptions with you. So I'm going to first of all work on the exception number 1. I'm first of all working on a contingent liability, and let's give you the concept straight. Now, one thing, if you look at the inquiry, for a contingent liability, he applied Ind AS 37. And if you look at the acquirer, the standard says that please forget about Ind AS 37 and please apply the parameters I give you in Ind AS 103. So when the acquiree decided it's a contingent liability, he actually applied Ind AS 37 to decide that it is a contingent liability. But Ind AS 103, you can say, overrides the concept of Ind AS 37 and tells the acquirer that for a contingent liability, you're not going to apply Ind AS 37. We will give you the guidance in terms of Ind AS 103. Now let's see what is the difference. If you look at Ind AS 37, a contingent liability arises due to 3 permutation combinations. I'm giving you an exhaustive list of possibilities when a contingent liability arises. You might remember the recognition criteria in terms of Ind AS 37, that there is a possible obligation that is a contingent liability. So one of the possibilities that it is contingent is because there might be a possible obligation. When an obligation is possible and not present, it becomes a case of contingent liability. That's one. Second, even a present obligation can become a contingent liability because the outflow is not probable. Because when you create a provision, you say there is a present obligation, you say that the outflow is probable, and you say that a reliable estimate can be done. Ind AS 37 has got a total of 3 parameters on the basis of which you say that, okay, this is supposed to be a case of provision. If you say there is a present obligation and you say that the outflow is probable and a reliable estimate can be done, it becomes a case of provision. So the second contingent liability can be that there is a present obligation. There is a present obligation, but but the cash outflow is not probable. It is not probable, it is not likely that outflow will be required to settle this obligation. So it is treated as a contingent liability. There is another third kind of contingent liability under Ind AS 37, and that is a very rare case where you say that it is a present obligation, the outflows are probable, but you say that a reliable estimate cannot be done. Even Ind AS 37 recognizes that if a reliable estimate cannot be done, it's a very rare case where you treat it as a contingent liability, but possible. So the third kind of contingent liability can be that there is a present obligation and the cash outflow is also probable in nature, but it is taken as contingent because no reliable estimate can be done. No reliable estimate can be done for this particular liability. So if you ask me in a practical life scenario, I would say that if I look at the balance sheet, the financial statements of the acquiring company, in the notes to accounts, I will find three kinds of contingent liability: a possible obligation or a present obligation, but since the outflow was not probable, it became contingent. A present obligation where the outflow was also probable, but we could not make a reliable estimate, therefore it is contingent. Now see what Ind AS 103 tells me. Ind AS 103 tells me that any contingent liability which is a present obligation and you can measure the fair value. They've got a very simple rule, and they say that any contingent liability which is a present obligation and you can measure the fair value, please put it in the entry. So let's apply the mind. So what is the criteria that it is a present obligation and the fair value can be measured? So let's see. If there is a possible obligation, can it be shown as a part of the acquisition entry? No, because it needs to be a present obligation. If it is a present obligation, and in this particular case, it was not taken as a provision because outflow was not probable or estimate cannot be done, does it appear in the entry? I would say yes, if fair value is, I would say, given in the question. Let's put it like this from the examination point of view: if fair value is given in the question. So if the fair value is given in the question, put it in the acquisition entry, simple and straight. So which means that many people have got a misconception that all contingent liabilities of the acquiree are a part of the acquisition accounting entry. No. I would say typically there are two kinds of contingent liability. One is a possible obligation, and the possible obligation does not appear as a part of the acquisition accounting entry. It is not to be shown in the entry. Second is that there is a present obligation, and it would definitely appear if the fair value is given in the question. All those contingent liability, which is a case of a present obligation, is going to be a part of the acquisition accounting entry. I hope I am clear. So when you look at a question, scrutinize the additional information that this contingent liability, which is in the notes to account, is it a present obligation? Is the fair value determinable? Is it known? Then it's a part of the actual liability in the acquisition entry. Great. So I think we can do a little question also on this area with you. So let's do one thing. Let's, I think, take you to an example on this exception. So let me go back to the assignment and let me take a question with you on this area. So let me just take you to the exceptions, and I think we've got a list of exceptions out here. Let me just get the new one. I think the previous one didn't get loaded appropriately. Just give me a second. Okay, I think I have not put any question on that area. Okay, I think let's forget that. I have not put any questions on contingent liability. I think the discussion is good. Let's go to the second exception now. Let's go to the area of second exception. This was contingent liability. Let's go to the second exception, and that is indemnification assets. So let's go to the second exception, that is indemnification assets. There is something in the study material. I'll just take you to the study material very shortly. Let's talk of the second exception, that is indemnification assets. Now the question arises that what is an indemnification asset? As the word is suggested, it says to indemnify. The word indemnification is made from the word called to indemnify. So let's imagine there is a court case against an acquiring company already going on. When the acquirer was planning to acquire this company, there was a court case already going against the acquiring company, and I knew that the acquiring company is going to lose that case. So why would I suffer as an acquirer? So I tell the acquiring company that once I acquire your business and this court case is lost, there will be a compensation required to pay that. You need to indemnify me for the compensations which I will pay. So you decide in advance that due to any court cases against your company, if I have to, pay money at a later date, you are going to indemnify me and you're going to pay me the compensation for the court case money which I lose. That is called an indemnification asset. Now, the only thing we need to be careful on is, imagine that there is a court case, and let's give you some inputs out here. A few permutation combinations to understand. So let's say there is a court case, and let's say the claim against the court case is expected, let's say three possibility. It is expected to be, let's say 5 lakhs, expected to be, let's say 8 lakhs, expected to be, let's say 3 lakh. Now, in the acquisition entry, you've already taken that contingent liability as an actual liability. So this is, let's say, already appearing. These are 3 different permutation combinations. So let's say in the acquisition entry, you've already recorded this contingent liability as an actual liability itself. Now, he tells me that I will indemnify. He tells me that I will indemnify, let's say to the extent of 4 lakh rupees. The acquiring company tells the acquirer that, okay, I will indemnify you. If there is a court case which is lost, I will pay you 4 lakh rupees. The question arises, can I record this as an asset in the acquisition entry? I can. But the only thing which I need to be cautious on is that this indemnification asset recorded cannot exceed the value at which the contingent liability is recorded. It cannot exceed the value of contingent liability recorded in the entry. If you've recorded the contingent liability at 5 lakhs, you can record the contingent indemnification asset at 4. If the contingent liability is recorded at 8 lakh, you can record indemnification asset at 4. If you've recorded the contingent liability at 3 lakh, you cannot record it at more than 3. That's 1. And let's say in this particular case, it is not recorded in the entry. Since it was a possible obligation, and therefore it was not taken in the acquisition entry, you cannot record an indemnification asset. So there are 2 important parameters for an indemnification asset to be recorded in the acquisition entry, and that is, if the contingent liability has been recorded, the indemnification asset can be recorded. Let's get it clear. If in the acquisition accounting entry, the contingent liability is recorded, then the indemnification asset can be recorded. If the contingent liability is not recorded, indemnification asset cannot be recorded. If the liability is recorded, the asset can be recorded. Liability is not recorded, the asset cannot be recorded. That's 1. Second, If the contingent liability is recorded at X amount, the indemnification asset cannot exceed that X amount. That is another parameter. That is another parameter. So the amount of indemnification asset in the entry cannot exceed the amount of contingent liability in the entry. So there are two parameters for indemnification asset. It is the contingent liability is in the entry, the indemnification can be taken in the entry, not contingent, not in the entry, indemnification not in the entry. But in any case, the indemnification asset cannot be recorded at the amount the equerry agreed to pay. It has to be restricted to the extent of the maximum amount, which is going to be equal to the contingent liability. So you cannot record more than the amount of contingent liability. That's it. Let's, I think, have a look at an example in the study material on contingent liability and the indemnification assets to get more clarity on these two exceptions. So let's take you to the study material, and we've got some interesting examples out here. Oh, I guess I have deleted that pages, I guess, maybe. Oh, the Elixir here sometimes created a problem, and I think that page has also got deleted. There are some very basic examples given out here, so not a worry. So let me now do one thing. Before I go further, friends, with you, I just want to first take a quick consolidation of things with you at this stage. Because I think before I take it further on step number 4, I need to do a quick consolidation, and let me see if any questions so far coming at your mind. Okay, I think Rahul, you said, so both present obligations to be considered except possible obligations? Yes. The present obligation whose fair value can be determined? Yes. But let me also tell you technically, the third one, which I said is a present obligation and the outflow is probable, but we could not make a reliable estimate. I think even the acquirer would technically not be able to make an estimate of a fair value. So technically, even that may not appear in the acquisition entry. I guess you got what I said. So there is a possibility that even a present obligation doesn't get recorded in the acquisition entry because a fair value cannot be determined. So the third one, there is a possibility of not getting recorded. Okay. So let's now take a quick recap, friends, with you on whatever we have done so far today so that everything gets deeply embedded in your minds. So let me just, I think, do a little consolidation of things with you. I know today must have been a little technical session. I know the standard itself is technical, so naturally things would get a little technical as well. Okay, let's get the chain of thought very clear. Now, hear this very carefully as I discuss. So just keep your mind relaxed now and hear me very carefully in terms of a mind mapping, which I'm doing. Because this standard is technical, so I promise that I'll keep making a few consolidations in between. But when we're going to do a larger question, of course, things would be much, much more clearer and you get a good stronghold on things. So I started my journey on acquisition accounting. We are not discussing reverse acquisition at the moment. We're not discussing a common control transaction. The focus is the acquisition accounting. And I said in terms of step number 1, you need to identify the accounting acquirer. You need to identify the accounting acquirer. Now, I'm not making the chart. The chart is already there with you. So I'm not interested in making any chart, just the crux. So what is the chain of thought you're going to apply? I'm going to first of all see that the purchase consideration is in cash. The purchase consideration is primarily in cash, or the purchase consideration is in terms of equity share. That's the focus point. Your movement is going to be very simple. Focus, the consideration is primarily in cash or primarily in terms of equity shares. Then, if it is cash, no further questions asked, then in this case, the legal and the accounting acquirer definitely is same. It is undoubtedly a case of undoubtedly a case of acquisition accounting. Doesn't make a difference to me whether a new entity was created or the new entity was not created. Okay, if the consideration is equity shares, I'll say, okay, let's decide, was the new entity created for the acquisition? Or the new entity was not created for the acquisition? Let's decide that question. If I say that a new entity was created, if I say the new entity was created, I am 99.99% sure the new entity cannot be the accounting acquirer. So I would say in this case, the legal acquirer and the accounting acquirer definitely is not the same. We can say it's going to turn out to be a reverse acquisition in this case. It's going to undoubtedly turn out to be a reverse acquisition in this case. And if I say that a new entity is not created, I would say that you should calculate, the post-business combination percentages. You should calculate a post-business combination percentages and then decide. It may be a case of acquisition accounting. It may be a case of reverse acquisition. You need to see that the control continues or the control is lost. So basis of this, you're going to see that the control continues or the control is lost. If it continues, it is acquisition accounting. And if it is lost, it is reverse acquisition. Crux. I think I have the assignment now. So after the mind map, I'll just quickly make a run through of one of the questions which I missed out earlier with you. Okay, then this was my step number 1. Then we entered the step number 2. Then I entered the step number 2 with you. In terms of the step number 2, the focus was on the date of acquisition. And when the focus was on the date of acquisition, we said, okay, date of acquisition is when you get a control. So I said date of acquisition is when we get a control. I said, by the way, there is another date which is called a closing date. And this is the date when the PC is paid, when the PC is discharged. We said, by the way, let's also tell you that there is something which is called a closing date as well. I said in a very idealistic situation. So we said in a very idealistic situation, we said the date of acquisition and the closing date is same. So if somebody were to say that, okay, when do you get a control? I said you get a control when you pay the PC. You get a control when you pay the PC, you get a control at that particular stage. I said, okay, that's great. But we said, can there be any exceptions? We said, can there be any exceptions when the date of acquisition is preceding? The date of acquisition precedes the closing date. You get a control before the date when the consideration is paid. I said, yes. The only exception is in this particular case when there is a written agreement. And what is important is that if the agreement is supposed to be non-binding, I said if the agreement is non-binding letter of intent, I said a non-binding letter of intent can't give you a control earlier. So in this particular case, it cannot proceed. It cannot proceed. You cannot say that we've got a control before we pay the consideration because it's a non-binding letter. If I say that it is a binding letter for that example, then we said, let's get it more clear that do we need approvals? You've entered into a binding letter of agreement, but is it something which is subject to approval or not? So we said it might be subject to approval, or it might be something which is not subject to approval. So we don't need any further approvals in this case. Well, if approvals are not required, you've already entered into a binding agreement with no approvals awaited, then it can proceed. You can get a control before the date of acquisition as well. This is more to, if you get a small little question on step 2 only, because in a larger question, the step 2 will never pose a problem. It will be very clearly given in the question. Then we said that if it is subject to approval, then I need to watch out more things and see that is this approval merely a formality that is procedural in nature, mere formality, or is it something which is not a formality, but it is substantive in nature? So we said, is the approval something which is substantive in nature, or is it merely procedural in nature? So when you say it is substantive, it cannot proceed unless you get the approval. Acquisition date cannot be decided. And if it is completely procedural, then yes, it can proceed. So this is the crux in terms of step number 2 as a part of the larger question. Step number 2 is not going to pose any problem because the date of acquisition will be very clearly given in the question. Okay. So this was on step number 2, and then I went ahead and took you to the step number 3, where I said there are 2 focus points. There are going to be 2 sub-steps within the step which you need to be clear. So there is a sub-step A and there is a sub-step B. You need to be clear in terms of the application of 2 sub-steps A and B. In terms of the step number A, you need to apply Ind AS 12 if tax rate is given. If tax rate is given. So the moment you are given a tax rate, you need to do the step number 3A. If the tax rate is not given, step number 3A not to be applied. So when you look at the step number 3A, what do you need to do? You need to see that there are net assets other than goodwill. You need to see that there are net assets other than goodwill. So do one thing, pick up all those assets and liabilities, and see that the carrying amount is equal to the fair value. See what is the tax base and get the taxable or deductible temporary differences and get a DTL or a DTA as the case might be. So you need to make a list and see that whatever assets and liabilities are there, whose carrying amount is the fair value, and that's not equal to the tax base. Make a list of those items, get the differences, get the DTA and DTL. Just apply Ind AS 12 in this case. And also remember that this is then when you look at goodwill. When you look at goodwill, you need to be careful that if this goodwill is going to give rise to DTL, don't recognize it. And if it is going to give rise to a DTA, please go ahead. So this deferred tax asset and liabilities is also going to be a part of the acquisition accounting entry. So all that DTA, DTL, which you've identified in step 3A is a part of the list in step 3B. Then we said, after you're done with the step number 3A, you make a list of the net assets. Now, what you need to be careful on is that when you make a list of the net assets, I said, okay, you need to take the net assets at a fair value. We said you need to take care of the list of net assets at a fair value. So mainly, I'm not getting into the entire list, but we know that the entire list is comprising of 1 plus 3 plus 4. So this is comprising of total of 8 items. So we said there are certain exceptions, recognition exceptions, measurement exceptions, recognition, measurement exceptions combined. There are 8 items to be taken care. But I said, no worries. In this particular case, if I look at the main items, if I just remember the main items is going to be number 1, the deferred tax asset and deferred tax liability, which you've already taken care in step number 3A. So when you're making this list, just take care of the DTA, DTLs, which you've taken in step 3A. Take them as a part of the list of net assets. Then watch out for any contingent liabilities. Watch out for any contingent liability, and these contingent liabilities are those which are present obligations. These contingent liabilities are those which are present obligation and the fair value is determinable. It doesn't make a difference whether the cash outflow is probable or not. Ind AS 103 focuses that if this is a present obligation, fair value is determinable. Please put it in the entry. So make it a part of the list of net assets. Then I said it is indemnification assets. Then I said it is indemnification assets. And in indemnification assets, we said, if you take the contingent liability, you take the indemnification. You don't take the contingent liability, you don't take the indemnification assets, and its value cannot exceed the value at which you take the indemnification asset. It cannot exceed the contingent liability value in the entry. So these are the three main things. Other than that, share-based payments not yet discussed. Reacquired rights not yet discussed. So they will be the main 5 items. Apart from that, I said employee benefits, non-current assets held for sale, take them at the same values which those standards prescribe you. So if there are any employee benefits, if there are leased assets, if there are any non-current assets held for sale, take them at the same values with those standards are prescribed. So mainly the list is going to be 3. And another thing which I told you, that when you make a list of this net asset, be a little more careful on another aspect as well. You need to be careful on another one aspect further as well, and that is that there might be certain intangible assets. There might be certain intangible assets which are not in acquiree's balance sheet. Which are not in acquiree's balance sheet because they were internally generated. So he never reflected those intangible assets in his balance sheet because they were internally generated. So can I say these will appear in acquisition entry? This will appear in the acquisition entry at a fair value. They will appear in the acquisition entry at a fair value provided this will appear in the entry, provided you can say they are identifiable. I guess you already know, as per Ind AS 38, what is identifiable. If they are capable of being sold, if they are capable of being rented, if they are capable of contractual rights. So if they arise out of contractual rights also, then also they would appear as a part of my acquisition entry. So in step number 3B, you've got some crucial things to be kept in mind, that you need to consider that if there is any deferred tax implications in 3B, take it. 3A, intangible assets of the acquiree not in the balance sheet of the acquiree, but they're identifiable, separability criteria basically met, and they're arising from contractual rights, take them at a fair value in the entry. Take care of the contingent liabilities, take care of the indemnification assets typically. So this is what I've given you in terms of the step number 1, 2, and 3. Out of the 7 steps, we're working on the 7th step, and 3 steps are done. Now the crucial steps left is the 4, 5, and 6. 5 and 6 is not a big deal. The step number 4, which is on a purchase consideration. Can you believe it's going to take one entire class on the concept of calculating the purchase consideration? Oh my God. Accounting Standard 14 in terms of IGAAP never used to take much time. One could finish things of a purchase consideration in 10-15 minutes time. But the level of issues pertaining to the purchase consideration in terms of Ind AS 103 is huge. But I'm going to give you such a beautiful insight on the purchase consideration and all the kinds of technicalities which can come, whether you get an independent question on step 4 or a higher level complex question on step number 4, you'll easily crack it. Okay, that's wonderful indeed. So I think on that front, friends, I guess we are almost left with not much time, I guess. So I think so far so good. Let me now get your comfort zones again, friends. Okay, I guess if you can possibly give me your comfort zone, because I think maybe your chat was not working earlier or something. Give me your comfort zone on a scale of 10 on your understanding on the 3 steps so far. Okay, and Rahul, so where do we get these Ind AS notes from you? You can download it from the portal. Once the class gets over, I put them, upload them, so you can download all these things from the ICI portal itself. Yes, thank you, Rahul. I guess any further questions coming in? I guess nothing coming so far, I guess. Then I think in that particular case, friends, we'll call it a day then. Then I think it's time to take leave from you at this stage. So I'm going to join you back on Saturday, friends, on the step number 4, purchase consideration. So I think time to bid goodbye, friends, to you on this. And Rahul tells me 9/10. That is superb. Wonderful indeed, friends. Thank you. Bye-bye and take care. हाँ जी, क्लास ओवर।